Hey everyone, welcome back to another live stream. This is supposed to be more of an open forum. If you guys have any questions, want to talk about whatever, I put up a post recently, which we'll start with in just a second, where I gave you guys a chance to ask some questions. I'll do that periodically. So if you guys want to get your questions asked and you can't happen to make one of these live streams, then you can always leave a comment there. Be sure to subscribe and hit the notification bell so you don't miss those posts. But anyways, it's been a pretty busy Sunday, as it has been really the last few months. Was looking at a property in Chicago, and it actually leads into one of the questions I got for this week. And yeah, it's been pretty busy, but we'll get to that in a second. Let's start with the questions over here with the community post I made a couple days ago. Share my screen. And we got the Benjamins in the background because, we're thinking big here, right? Here's a picture from the 80th floor of the Willis Tower. This was back in the summer when it was more green out. It's been a relatively mild winter so far, knock on wood, but we always get that at least a couple weeks of extreme cold here in the Windy City. But that actually is this question from Herbo Swervo. How do you feel about the future of Chicago given everything that's going on right now? Since, for those of you who don't know, I'm in Chicago, I work in Chicago, I own a couple properties in Chicago. I do own one out of state as well in Indianapolis. But as for the opportunities in the city, how do I answer this question succinctly? Or maybe I can't. My feeling about Chicago is generally not that positive. The trends are not so good. The political environment is troubling. There's always the problem with violence that's been just ongoing for many decades and has not really gotten any better. If anything, it's gotten worse in some areas. It's not particularly a problem in the area I'm in. We're near the northern tip of the city, and that's where a lot of the money is, and that's where a lot of the crime. That's not where a lot of the crime is, thankfully. I guess it's not really a good thing because the crime has to go somewhere. A lot of it is concentrated on the west and south sides of the city, which does affect the whole city because you have to divert resources towards that. Or if you don't, then it exacerbates itself, which we've seen. So all that's not good. I don't really see that getting better anytime soon because you need a pretty massive fundamental shift, not only with policy, but it's kind of a generational thing. If you have a whole group of people who grow up with gang violence all around them or just poverty or whatever, that takes a while to unwind and get people out of that. It takes a very coordinated effort, and that's not always politically feasible either. It's expensive usually, so it's not easy to do, so I'm trying to say, and I'm generally not that optimistic that the government can do something like that very efficiently or fast without some serious drawbacks. So yes, the general trend is troubling. However, as for myself, my greatest opportunities right now are in Chicago. And if I were just to hop ship and go to some other market right now, whether it be for my career, for real estate investing, I do invest out of state, which I'll get back to. But my biggest opportunities right now are in Chicago, and my family's here. My wife's family is here as well. So that is another pull factor keeping us from leaving right this second. But it wouldn't make a lot of sense for me to just jump ship right now. It's not that I'm saying I'll never move from Chicago, because if there's a great opportunity elsewhere, I'm never going to say never. And in any event, I could always move my money out of state, which is what I'm already doing in a large way. I own a property in Indianapolis, has different demand and supply factors compared to Chicago, has different political risks. So I focus on trying to diversify that way. Even if myself and my own career risk, I suppose, is in Chicago, I can at least get my money outside of the state. I also invest in plenty of stocks, which have all sorts of different risk factors that aren't specific to Chicago and the greater state of Illinois, which has its own set of corruption problems and horrific spending problems, debt spending, that is. So it wouldn't make sense to jump ship right now, and it probably won't for quite some time. We'll see where my wife's at once she's done with grad school. Maybe it'll make sense if she gets a better opportunity outside of the state and I can stay with my current firm because they do have multiple offices throughout the country, which is a great plus, or could be, as long as they're open to me moving. But I'm not looking to do that right now, and I'll cross that bridge when it gets there. But I do have it in my mind that that could happen. Just realized my microphone was not on. Now it is on. Could you hear me at the beginning part? Someone in the chat, Mike, I know you're here. Could you hear me for those first few minutes, or was my mic off? um, that's awkward. I hope I was not muted there. Oh no, it's going through my camera audio. All right, we're good. Now let me switch to my mic. This should be slightly better audio. Whoopsie. All right. Okay. Sounds good. All right. I got a little worried there. That was just rambling for 5 minutes. So I think it was going to the camera audio. Now I should be on my microphone, should be a little bit crisper. But anyways, so my opportunities are best in Chicago right now. And there might be better opportunities in the future in another market. My wife and I have looked at Texas recently, as many people have. Just there's a lot of great pull factors. I've already talked about push factors, but what about pull factors on the other side? There's pull factors in lots of great markets. The Texas market is great for I'm not just talking about real estate, but for jobs, for just general economic growth. There's a lot of good tailwinds there, and that could be a nice pull factor. But I'd want to do something where we could coordinate moving family, and we're not in a position to do that at this point. Maybe we will be in, I don't know, however many years. Then it might make some more sense. But if we were to jump ship right now, it'd be leaving family, it'd be potentially messing up my job prospects. And I'm not really sure where my wife's going to be working at this point either. So we're focusing on making the most out of the opportunities we have now. And if something else pops up in the future, then we'll do it. But for now, it just doesn't seem worth the cost and the risk to do that. So that's what I would say there. And I know we talked a little bit, or Herbo says that he was born and raised in the suburbs, as was I. But he chose to do a big law summer associateship in a bigger market that's growing pretty fast. So that's great. Congratulations there. He's going to make the permanent move. It's a hard choice, and it's not unique to Chicago. A lot of the big cities, especially in this last year, they've had pretty sometimes draconian policies, but it's not like it's anything particularly new. There's been a lot of just not sustainable things before we even got into the pandemic and all that. And it just kind of sped some things up for some markets. And plus, you had the move to remote for a lot of larger companies. So all of a sudden, a lot of white collar workers suddenly didn't need to be in a particular market to actually work for a company there, and they could just move. And you're seeing that in the office market too. Companies are realizing that too, and they're moving a lot more easily a lot more easily than they might have before. Because they feel emboldened that they can do remote work. Maybe I would do something like that in the future if it makes sense. My wife wouldn't really be able to do that though, because she would be doing audiology in all likelihood. That's what she's studying for. So you have to see patients. It's a physical presence. It's not as though you could do all that remote. You could do some things remote, but it'd be pretty difficult and probably not that feasible, at least starting out. Maybe if she had a big client base at that point, maybe it can make sense, but it's a totally different ballgame compared to traditional audiology practice, but we'll see what happens there. So thank you for the question, Herbo, and congrats on the summer associateship. That's all I had on that post. Again, if you guys want to pop your questions there. If you can't make it to a live stream, I'll always use this as kind of the starter questions. Otherwise, I like to go through the chat. So if you guys have questions, I see Mike has one here. We'll get to that. If you have questions, leave them in the chat. And if you're watching this after the fact, hit the notification bell, and then you'll get any notifications when I put a community post out, and then you can answer or post your question or whatever you want me to chat about. All right, so let's see here. We got Mike just posted on Discord. I believe that'd be the Punch Card Discord, which you can join by going to Punch Card Investing and checking out the description there. But interested in my views on valuations based on earnings per share growth rates and PE ratios versus discounted cash flow methods using free cash flow. Well, in my I don't know if I understand the question exactly, but in my discounted cash flow model, I have a terminal multiple there. So um, it's kind of built into the model, some sort of either multiple expansion or contraction, depending on what the current multiples are. I generally just kind of use a historical free cash flow multiple of somewhere between like 12 and 15, because that's typically what the market is around. If we're just looking at a very broad trend, that's not to say that that's going to be the case in the future, but that's just my benchmark that I use. And sometimes that's way above what the current multiple is. Sometimes it's way below. It depends on the company. For a company that might be more mature with less opportunities for growth, but doesn't have a particularly strong moat, it might have a lower terminal multiple. For a company that still might be mature, but has a rock solid moat, it's not going to go anywhere, and people might pay a premium to that compared to others. I might use something closer to 15 or on the higher side, something like that. So it's always factored into my discount kind of cash flow models, because you have to have that terminal value of the business in there too when you're buying a company. So yeah, I'm counting all the cash flows, but then you're also adding the final value of the business. You're discounting that too. So you got to keep that in mind. But otherwise, I try to make conservative growth assumptions in any event for valuations, and or if I'm not making particularly conservative growth assumptions, I'll jack up the discount rate, or if things are uncertain. So it works the same way in either event. I'm just trying to be more conservative than I might. It's weird. It's like I'm trying to be more conservative than I would be comfortable with to make myself more comfortable with the investment. It's kind of a weird sort of paradox. Because I would like to believe that, oh, it's going to hit all these projections. But then I'm reminding myself constantly that the more conservative I can make my assumptions, and if those assumptions still work, that just means that the opportunity looks that much better. So I just keep reminding myself that it's almost against our psychology. We want to be optimistic about things that we're interested in. And if you're interested in a company, you want to be optimistic about their growth projections. Maybe you just heard an earnings call where they're real positive about, hey, yeah, we're going to keep up 40% growth per year for the next decade or something ridiculous. Like, you might think, oh, okay, well, 30% sounds reasonable from there for 10 years. Again, like you got to measure your assumptions. Depends on where you're coming from, of course. But that's what I would be worried about there. Just trying to be conservative with growth assumptions in any event. And that goes for the ratios as well, for your terminal multiple, for PE ratios, whatever you're willing to pay for the business. You want to be pretty conservative there. And this is where a lot of people, I think, fall into a trap of relative valuations, where they're comparing they're comparing their company to some other company that is super richly valued, and they're like, oh, well, X company has a 2000 PE and this company only has a 100 PE, so therefore it's way cheaper and it's grossly undervalued. Well, if you're comparing one overvalued company to another one, and the other one is just less overvalued, they're both still overvalued. So you have to be really careful there when you're talking about comparing PEs. That's why I kind of use the blanket rule of something like a 15 PE or terminal multiple for free cash flow, because that's what history has suggested, is like an average. But it's not a hard and fast rule. But I think the more you can take kind of guesswork out of it, the more you can follow a reasonable, mostly conservative at least method, that would probably be helpful. But it depends on your strategy, of course. I'm very biased towards the long-term investing approach. Maybe you're going for short-term moves. Maybe you're going for momentum. That's a totally different ballgame. So I hope I answered your question there. Mike says, I guess I'm interested in the capital spend need variances between different earnings metrics. Well, that would be factored into free cash flow, because free cash flow is cash from operations minus capital expenditures. So the lower your free cash flow, that would imply either that there's more capital expenditures or less income. So it should be baked into the model, unless I'm misunderstanding something, either with the question or with my explanation. But that's how I view about it. And every business is going to be different. Some are going to be very capital intensive, but in that case, the free cash flow number you're going off of is probably lower, or it's not going to grow as fast. It should be factored in. assuming the free cash flow numbers are done honestly and accurately, because it might not work for every business. A REIT might be very different in its income calculations because of all the tax write-offs, depreciation, all that. So earnings might look very different than something like the net operating income, which might not really be accounted for, or it might not be shown very obviously on like an income statement, because it's a different sort of accounting. So it depends on the company is really what I'm getting at there. Uh, yeah, that's what I would answer there. Otherwise, good question, Mike. Ahmed Finance. Any thoughts on Alibaba or investing in China in general? Well, sure, I got thoughts. Doesn't mean they're insanely valuable, but I'll give you my thoughts. With Alibaba, I do own it, and I've been actually investing. I've gotten it up to a pretty significant position in my portfolio. I mean, it's not life changing the position I have in there, but relative to my portfolio, it's something like probably 5% of my stock portfolio, and uh, it's almost been, I don't want to say it's been by accident, but as I opened up a very tiny position around like 220, probably, maybe 200. It was actually back when Ray Dalio invested into it pretty heavily. I think it was November 2020. It was something in like the lower mid twos. I wasn't really paying attention much. It was kind of more of a big tech sort of blanket clone, and I wasn't too ingrained into my value investing approach yet. So I was being pretty cavalier with where I was throwing money around into my stock portfolio. But that was what initially got me more interested in it. I knew it was a large tech company in China, so that was when I started it. Then we saw Charlie Munger buy it in early 2021, and that set off this flurry of investments from our more respected value investors, at least the ones that I would respect in this space. So I added some more there. It still was very small relative to everything else. And then we've seen what happened over the next, almost year now. It just went on a nice long free fall and is all the way down to like 120 now or something like that. So I bought it a dollar cost average down pretty much the whole time, because it was just like, well, I'll get to the risks, but the risks I saw are now being, the risks really aren't any different than what I thought, or this is my take on it. I didn't see the risks as being any different than they were when I initially made the purchase. So now all of a sudden my risk is actually going down because the price is going down, and that's ultimately what determines your risk. It's how much money you put in. So if the price of the stock is coming down, then that means your upside is greater, or maybe not your upside's greater because your upside's technically unlimited, but your downside is less because you're putting less up. Relative to the shares you're getting. So that's a long way of saying I've built up the position as it's gone down. But as for investing in China, this affects Alibaba, of course, being a large Chinese tech company and e-commerce in particular. My biggest worry about China and Chinese stocks in general is the reliability of the accounting and the reliability of the numbers we're getting. We being here in the US, or I guess the whole world, I suppose. And that's because we've seen some pretty recent large scale frauds. We saw Luckin Coffee, that being probably the most recent huge example. And it's very concerning that was able to happen with the amount of money that went into it. Not that frauds don't happen elsewhere, but China operates on a pretty significantly different set of rules. Whether people understand it or not, people might say, oh, well, PwC does the accounting for whatever Chinese firm, but it's not PwC like here in the US. It's the Chinese arm of PwC that operates by a different set of rules, because China and the US at least haven't agreed on a fixed set of rules for accounting. So we being the US and China are not on the same page when it comes to accounting rules. And people might believe that they are because, oh, how could it be a problem? It's the same big accounting firm. Well, no, it's not. It's a subsidiary of the accounting firm that operates under Chinese rules. So you got to keep that in mind. Now, that's not to say that all Chinese companies are a fraud. There's not that much proof of that, but it is a concern. And I think it's a larger concern versus like a US company, where it seems like things are a little bit more reliable. Maybe that's just a bias that I have as an American, but I think there's a little bit more track record there with stamping out fraud and all the reporting requirements. Not that it's all eliminated. Of course, you're never going to eliminate it all. It's humans operating an imperfect system. So That's kind of that's what I see as the biggest risk. Then you have the obvious other ones that the media loves to just march out. The regime, that's going to be a risk. It's huge. But then again, the US government is a big risk to many companies too, whether it likes to believe it is or not. The only difference is the Chinese government can operate a lot more swiftly with stamping up behavior they don't like. So that's, I guess, sort of unique, but not really. The uniqueness is kind of the speed and potency in which they can roll out big restrictions. The U.S. can do plenty of restrictions too. It can decimate entire industries based on, removing credits or granting some monopoly privilege. They can do plenty of stuff the U.S. is not some free market haven, is really what I'm getting at, and neither is China. So those risks are kind of similar, but worth noting. And then the other big one is delisting, but that also could kind of go both ways, but definitely would more heavily hurt Chinese companies, at least I would think, if all of a sudden the the US or China decided that US investors can't invest in Chinese stocks for whatever reason, which is always kind of, it's like, it's always dangled out there like that's going to happen in the next month, but it never does. So it's probably just media hyping it up because it gets clicks. I don't know how likely that is. On the one hand, it seems like it would be unreasonable that the regime in China would say, "Hey, we're gonna stop accepting U.S. investment," which seems kind of strange. Like that would be hurting their companies a lot more than it would be helping. At least I would think, because you just would suddenly shut off this massive supply of capital uh, that's been pretty instrumental in propping up a lot of these companies, as far as we understand. And it seems like it'd be against their interest to do that, but you never know, because the government in any society can get pretty unreasonable at times. So and like I said before, they have a lot more power to do things pretty swiftly, and maybe that'll be a bad decision if they end up doing that. I'm not saying that's likely, but it could happen. On the flip side, the U.S. could decide that, hey, we don't like China because of some reason, maybe some tensions rise over some political issue or something, and all of a sudden that hurts, and the US decides, hey, we're not going to allow this, and we have to delist all Chinese stocks. That it could do the same sort of effect. So either party can do the same thing. They can delist it, and as a US investor myself, that would hurt, because the company value would suddenly be destroyed. Well, not the value of the company, but the price would almost certainly go down, because you'd have way less investors who could buy into the pool. Now, for the long term, is that really a bad thing? If you can buy into the company at a cheaper price, if it's really worth what you think it's worth, it's debatable. You would probably want the relisting to happen at some point, so you could get 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 that multiple expansion again, if you will, like we were talking about earlier. That would be a risk too, but it's a kind of a different sort of risk. So I think, let's see, we talked about regime, delisting, accounting, reliability. That's kind of the three big things that I throw into the buckets. Otherwise, I mean, I guess you could throw out kind of more macro things. We've seen the Evergrande crisis, and Alibaba and many of these larger firms are going to be probably pretty tied to the growth of the Chinese economy, because they're so huge already. And if the Chinese economy suddenly isn't growing, that's going to hurt, but that's probably going to hurt the whole world at that point. So if something like this Evergrande crisis, all the debt that the Chinese system has, they have a lot of debt, their corporations, at least that we know, assuming the accounting's reliable. Even with their accounting, assuming, let's say the accounting is not true, even on the not true accounting, it's very large amounts of debt across the board that we know about. So, but I'm not saying that's the case. We'll assume they're accurate, and even if we assume they're accurate, it's a lot of debt, no matter which way you spin it. And that's a big risk to the system. If people start defaulting on that debt, or if companies start defaulting on that debt, in the Evergrande's case, if real estate suddenly tanks, that's a very important part of the Chinese economy. All of a sudden, that's going to hurt a lot of Chinese pocketbooks, and would hurt Chinese companies. So that's what I would say there. But that's kind of, it's very hard to predict these things, and how they would affect specific companies over the long term. In the short term, it wouldn't help anyone, but who knows what the policy response would be? Who knows what the business would do? As long as you are confident in the fact that you're buying into a great business at a good price, that's probably the only thing you can really focus on to insulate yourself. It's very hard to predict a lot of these things. Really, maybe it's not hard to predict
like that there will be a collapse in something. The hard part is predicting when it will happen, because you can be off by decades and you could say you were right, but meanwhile you could have made a bunch of money in that last decade. So what were you doing the whole time? So that's why it's frustrating. I mean, you can't really time it like that, or it's very hard to. At least maybe you have a crystal ball. I don't. So that was my long-winded answer on China and Alibaba. Thank you for the question, Amid Finance. Herbo in the house. Thanks for the question earlier. What impact do you think the president's refusal to extend a student loan forbearance? Um, what impact will refusing student loan forbearance have on the economy? So for those of you who don't know, in the US there's been a student loan freeze, where it's benefited our household, since we have quite a bit of student debt from my wife's grad school. It's been 0% interest, no payments for the last like a year and a half or something ridiculous. and um, and that's apparently going to be coming due in end of January. They're going to stop that forbearance finally, and are going to start charging interest again. Uh, First off, I'll believe it when I see it. I don't necessarily believe that this is the last. There's no guaranteeing that they're not just going to kick the can another month, just like they did with mortgage forbearance and eviction moratoriums. How many times did we have a final extension of all these programs? They do eventually come to an end, but what's the Milton Friedman quote? There's never anything more permanent than a temporary government program, kind of like that. So I don't. Eventually, this should end. I don't know when it will. Maybe it will actually end of January. So if we assume that does happen, it's going to. How do I? On the short term, it's going to hurt for sure, because you're sucking money out of the economy to pay for this debt. But in the long term, you have to clear that debt at some point. You can't just leave it there. Someone is owed that money. In this case, the U.S. government. And if the U.S. government doesn't get the money back, well, everyone else who doesn't have student loans is going to pay for it essentially. And anyone who does get student loans gets the benefit of that. And also, to that, there's been a lot of talk about student loan forgiveness. If the US government were suddenly to forgive student loans, first off, they'd be like handing out a check to the middle class, because that's ultimately who goes to college in a much greater proportion than any other class. So it wouldn't be really helping out poor people as it might be pitched. But either way, if they were to do that, it would be a gigantic welfare check, basically, to my household, anyone who has student loans, which is not the whole population. It's what is it? I forget the exact proportion of the population. I don't want to say a third. I think it's like a third of the adult population has student loans. Don't quote me there, but whatever. It's a large portion, but it's a comparatively privileged portion. So it'd be very interesting if that actually were to happen. And either way, I could almost guarantee that. Well, what I was going to say is that it would have a pretty substantial inflationary effect. And the only reason I say that is because people would have less debt payments to make, but they've already kind of had less debt payments to make. So I don't know if there'd be a stark shift. Maybe people would be more loose with their spending, knowing that they don't have student loans, because it seems like they already have over the last year and they didn't have to pay them. Man, the whole student loan system is just so, because you're giving 18-year-olds in many cases hundreds of thousands of dollars when they've never even held $1 to their name. And then 6 years later, they're trying to figure out, wait, how did I rack up $90,000 in student loans? Now what do I do? And they've never been taught financial basics and the fundamentals of saving and investing and all this. And all of a sudden they have to deal with a mortgage payment essentially without actually having a house. So it's a very, yeah, I don't like the system at all. Plus, it drives up tuition costs, because now there's just more money going towards it. It's a moral hazard, unfortunately, because colleges know that they can get students who come in to pay at pretty much whatever price, because the government's going to foot the bill. And because these 18-year-olds or 20-year-olds don't know what they're doing, they're like, sure, whatever, I'll pay it off later. Or they don't even know what they're doing. Parents signing up for it might not know what's going on, or they just think that, oh, I have to do this. It's just a, dare I call it, nefarious system. It's just not it's not exactly how I would prefer it, but that's how it is. It's a massive $1 trillion debt burden now. And if the government were to suddenly waive that, that would have an effect, we'll say. Basically, like, I guess what's another $1 trillion in spending for the government that we've seen over the last few years. But yeah, it wouldn't help for inflation, I would definitely imagine. So I went off a bit of a tangent there, but thank you, Herbo. He says he asks, presumably many Americans will likely decrease investment now that they will have an additional liability to take care of. Yeah, exactly. This is probably what would happen, is just like mortgage forbearance, when that ended, you suddenly had a mortgage payment again. That's expenses. What's interesting is during the whole, I mean, the pandemic's still going, but in 2020, incomes actually went up, even though we had a pandemic that substantially reduced business activity for a long time. But incomes actually went up because wages pretty quickly recovered, just average wages. You can cherry pick counterexamples, of course, on an individual or even like citywide basis. But incomes in general went up, and the difference in income growth was almost entirely factored towards basically welfare payments, transfer payments, as they're called, like the stimulus checks, like all the unemployment benefits. So people's incomes actually stayed the same or went up, and that's almost certainly why we're seeing so much inflation, because you had less people actually working, but more income just across the board to buy all this stuff. So basically, people's incomes didn't go down, even though there was less stuff being made. Now you have all the supply bottlenecks because people basically didn't stop spending because they didn't need to, because they had money being given to them. And so in a similar way, now that forbearance is ending, maybe you'll see some of that spending come down, but now there's just a lot more dollars floating around too. That's an added wrinkle into the inflation problem. I don't want to oversimplify it, because I kind of am, but that's my kind of general like overview of part of the reason we're seeing a lot of inflation. There's many reasons, but that's a very substantial one. You just have a lot of money injected in the economy while people weren't working. Those two things combined, basically less supply, more demand, or similar demand. Ta-da, you get inflation. So how sustainable will this rate of inflation be? I think it largely depends on how much debt spending the government's going to keep doing and handing off to the Fed to print money. But yeah, we'll see there too. We like our large programs here in the US. So I would bet on inflation not slowing down too much, but that's just me. You can think whatever you want. Again, not to get too much into a crystal ball, but that's what I would say there. Thank you, Herbo. Art Best says gold and silver in 2022. Sure. I own a substantial amount of commodity stocks, including, I don't own physical gold yet. I think I will eventually. Just I do own the spot ETFs and then a number of minor ETFs, just kind of to have some exposure there. I also have like a uranium ETF, which is like doubled over the last year. And that was more of like a Green New Deal sort of thing, and to have some commodity exposure. I have a copper one, which part of the EV craze as well. Going to need a lot of copper for these things. I have a decent amount of commodity stocks, and that's not really to create a massive return, but more as a place to park cash, have some equity upside. This is my view on it. You can believe whatever you want, because ultimately commodity stocks are linked to the price of the commodity, and that's a lot of fortune telling on where commodity prices are going to go. But given all the printing that was going on, I was betting on commodity prices not really going down, because demand was up because of all the extra money floating around. You have people with greater incomes, companies with more money to spend, and that would trickle into commodities, I would think. So could gold and silver do well in 2022? Sure. I think pretty much anything with any real value will probably do good in 2022 if we keep seeing the same levels of government spending and inflation that we're seeing. There should be some hedge. Though I really see gold in particular as more of insurance against, dare I say, the apocalypse. If we get into massive inflation territory, like double digits, I don't think we'll get into hyperinflation territory anytime soon. But if we see something like the 1970s, where you have double digit inflation for many years, which I think easily could happen, then it seems like it'd be nice to have some gold mixed in there while you wait for some other opportunities. And if you have fixed rate debt, ideally that asset in the gold or whatever asset you own, I don't think it has to be restricted to gold or any particular commodity, just something that holds value. Maybe that's a company, maybe that's a piece of real estate, maybe that's a piece of gold. Everything's going to be somewhat exposed to the general market, so it's not as though it's a complete safe haven. But gold in general, I think, probably makes more sense as a total like insurance policy if currencies completely fail. Uh, you could argue cryptocurrency has a bit of that built in too. So if you want that sort of exposure, maybe that's a way to go. It depends on how you want to view. It depends on how you want to view gold. I don't see it as a way to make a ton of money, but as a place to park cash, have some hedging maybe for certain bad situations. It's rather correlated to the stock market from what I've seen. It's not as though like when the stock market goes up, gold goes down, or gold goes up when the stock market goes down. That's not really how it works. They're pretty tied to interest rates, both of them, interestingly. So don't, and it's also a piece of gold. Like you're not gonna it's just a rock. Like you can't, it's not going to throw off cash flows. Warren Buffett said that many times, and many investors. It's a rock, just like any commodity. Maybe you have some use for it, but it's not going to actually produce anything unless it's used in a business or some sort of venture. So keep that in mind too. Um, People get very passionate about gold and commodities in general. I don't really know why, but yeah, I think they can have a place in a portfolio, especially in an environment like this where there's lots of government spending, a lot of instability in certain places, and maybe you don't have opportunities that you'd rather put your money towards. So that's my view there, and it kind of depends on where you are in your investing career as well, and how much you value having that insurance if you assume that gold offers that. Thank you, Art. Hi, Christian, the MVP editor of the channel. What do you do to prepare for tax season? What do I? This year might be a little bit more difficult. Not really. Had I bought another investment property before year end, I still got 2 weeks. Knock on wood, right? Maybe I can close before then. But I pretty much collect all of my documents through January and February because I still work a W-2 job, so I'm going to be getting a W-2, so I got to wait for that. I try to track my expenses through the year. It's not too out of control yet because I have some expenses for YouTube, like paying you, Christian. I have some expenses for some blogging I do, but that's kind of tangentially related to YouTube. So just kind of keeping track of those through the year. But even if I miss a spot, I can always go back and take a look. Same with donation receipts or anything in particular. But the big items are my real estate. That's going to have depreciation factored in. And I hand off my real estate that's in an LLC. So it's really the Indianapolis property right now. I hand that off to my accountant. They do business tax returns. So I need to have a separate business return, and then I have my personal return. And the business income will eventually make its way onto my personal return. So anything I make after depreciation and write-offs from the business will go onto my personal taxes. I might actually hire an accountant to do my personal taxes this year because I now have 2 properties in my personal name. I have one in a business name. And then I also have the YouTube business, which is actually bringing in some income now, not anything super substantial. But I think it's worth getting things set up now, and I don't want to miss certain deductions. It's getting more complicated. Plus, my time is more finite than it might have been last year, even though I was studying for the bar at the same time I was doing those were dark days. Or was I doing the bar? Yeah, I was doing the bar in February, which is when I was starting my taxes. And then in March I started my job, and that's why I didn't want to do it last year. But this year I'm working full time as a big law associate, and it's a lot of hours. Plus I want to keep up YouTube and all this, so it probably makes sense to hire out my personal taxes this year too. And definitely next year when I have a full year of income, and it'll make sense just to pay someone at that point because the tax savings could be pretty substantial. I think this year they'll be kind of significant if I hire for professional help. Not that I would be missing a ton of spots, I would think, because my return isn't too complicated yet. At least I don't think. I got a couple of properties in there. Just make sure I get the depreciation in correctly. So I'll be handing it off. Business taxes to professionals for sure. I'll probably hand it off to for my personal taxes as well this year. So that's what I would say there. Thanks, Christian. Ahmed, thank you for your thoughts. Appreciate the time. Thanks, and I appreciate the question. And thank you for your time and stopping by. And that goes for everyone. Cancel student loans. I know it's always a talking point because it gets people fired up. There's a lot of people student debt. But then nothing ever comes of it. I always find it funny that You see all this money shotgunned into the economy, and then student loans are always left to the side. It's just kind of funny that it's just this. Oh, it's this constant tease with student loans. RC Hung 632. Have you considered selling Alibaba now, taking the capital gain losses to offset other gains, and then purchase Alibaba in 2022? And so that'd be tax loss harvesting. The problem is you have with a stock that's been as volatile, just on the downside, as Alibaba. I'd be a little worried about that, and I don't have a bunch of gains to offset. Um, and all I would be doing is lowering my cost basis on Alibaba, which would mean if, when I go to sell Alibaba in the future, uh, eventually, talking years down the line, if I hold it for a long time, then my cost basis would be lower, so my taxable gain would be higher, and that's no good. So it'd be kind of a wash at that point. Time value money would say, okay, well, you want to save taxes now rather than later. But I don't really have many gains to shave off. It wouldn't be that much because I haven't done a ton of selling this year. I've done kind of some rotations into other stocks, sold some stocks at a loss, some at a gain. So probably pretty close to neutral. That's something I should look into on how many gains have I sold versus how many losses. But I generally have held and just kept adding to pretty much all my positions. Though not a half bad idea if you really have some big taxable gains, because then even if Alibaba goes up a bunch all of a sudden and you miss out on some of those gains over the month, if you're setting off enough taxes, it can make sense. Granted, the amount of money you can take in capital losses or net losses, I take that back. I was going to say if it goes, I think you can only take a few grand off on net of capital losses, but if you have a bunch of gains, you can set off all those gains. So yeah, it's definitely a viable strategy, just not one that I'd probably be looking at this year, just because I don't think it makes that much sense. But good question. Thank you, says Herbo. No problem. And here's Eric saying, I own physical gold and silver, not as a currency hedge, but an end of the world hedge. Not a half bad idea if you're worried about that sort of thing. I don't think I'm at that point in my investment career, as I'd rather build up my income producing assets, the ones that will produce significant returns over the long term. I don't see gold as one of those things, and it sounds like you don't either. But once I have more assets to protect, a lifestyle to protect, then I think it would make more sense to focus more on insurance policies, whether it be gold, real estate in other countries, that sort of thing. That's something I definitely will be looking at doing, probably sooner rather than later. Maybe probably within the decade, I'd want to have a property in another country. So sometime in my early 30s, I think that would be a pretty good goal to have. Hey, if YouTube takes off and I'm flush with cash, maybe that'd be one of the first destinations. But once I'm financially independent, I want to get to that level first. Then I'd be looking more defensively, but still trying to grow, of course, not just trying to stop. But that's how I would prioritize. End of the world hedge, though. I could get behind that, I suppose. Herbo again. What courses would you recommend an incoming summer associate to take during 2L? So 2L is your second year of law school. I mean, it depends on what practice area you're going into. Like, I was a real estate guy, but there's also you have to get through your actual law school requirements. So I'd probably focus on the requirements first. So if you wanted to graduate early, potentially you could do that. That's what I did. So I just wanted to make sure I got all the core classes out of the way quickly. So then in my last year or so, I could take I could just fill whatever class I wanted to into whatever time slot worked. Basically, I was trying to remain flexible with my schedule rather than in the actual topics I picked, if that makes sense. Though I'd always try to get some real estate courses. So I'd say it depends on your actual niche you're going into, as well as your schedule, as well as what requirements remain and your goals if you want to try and graduate early, because it sounds like you have a good opportunity lined up. So that was kind of a vague answer, but those are the factors I'd be considering. Oh, here we go. Side note, I'm going an open-minded and willing to try anything, but I suppose capital markets, real estate, and trademarks are top of my interests. Those are pretty those are pretty diverse practices. Um, so my summer associate at the firm I'm at now, it was actually specialized. I actually didn't have the summer program because it was canceled, but it was special. It was going to be specialized into real estate immediately. Some firms will do like multiple. Uh, they'll have you rotate through multiple practice areas. I would probably pay attention more to the teams you're on when it comes to your actual associateship. You want to work with people you like working with, unless there's just a practice area that you're dying to be in. For me, I definitely wanted to do real estate and did not want to do anything else. So whatever the team was, I would go for it. But I actually like my team, so that it's just an added bonus. Um, so yeah, I mean, be open minded with law school. That's what law school is about. It's about exploring, and I'd rather learn that I don't like a practice area in my class rather than in on the job. So that's what I would say. If so, try to take those classes, I suppose, if you can. David, what business would you invest in if the stock market was closed for 20 years? Ooh, 20 years is a long time, and I can only invest in one. Um, I'd probably want it to be a very mature company because the fundamental risks seem like they'd be lower than maybe a smaller, growthier company. So I might not make that much money compared to growthier opportunities, but I always want to have some sort of recourse if something changes. And in this case, I don't have recourse for 20 years, which is a little bit dangerous. Um, all right, cop out answer. Then I think an answer you're actually looking for. Cop out answer. I'd invest in myself. I'd invest in my own real estate business, but that's kind of cheating. Otherwise, maybe like a Berkshire. That's what's coming top of mind because they're kind of primed for like any situation. They have a bunch of cash. They have a lot of good holdings. They have good capital allocators. So it's probably what I'd lean with. Even if they're trading maybe a little bit steep right now, it depends on how you look at it. That seems kind of like a decently safe pick in my own view. Yeah, I think I'll go with Berkshire if I had to pick one, and then it's closed for 20 years, and then I'll revisit it 20 years later. It's been around for a long time and seems to have no signs of slowing down. Well, maybe it'll slow down, but it's not going to disappear. I'd be worried about downside, and if you protect your downside, the upside should come. But yeah, it depends on what they invest in next, especially once I'd assume Warren and Charlie would be gone by that point. Maybe they'll live to 120. Who knows? But that's what I'd say there. That's a good question, though. Thanks, David. Eric says family is from less stable part of the world than the U.S. Have ingrained in the kids to always have some good way for a quick getaway. I think you're talking about like your gold. It sounds like you have a gold bunker somewhere that you can run your hideout that you can flee to if you really need to. Yeah, that's kind of. I mean, maybe not that extreme, but yeah, definitely having some options. I definitely am interested. There's actually this great channel on YouTube that you might be familiar with called Nomad Capitalist, and they talk about the value of having multiple citizenships, multiple passports, and just being able to get out of Dodge if you need to, having different options. Their motto is "Go where you're treated best," and not that I'm trying to leave the U.S. anytime soon, if ever, but just having the option in case something does happen, because countries aren't forever. The U.S. is we're at 200 something years, and that's like half of what the Roman Republic was. So, like, kind of long ways to go if we're trying to meet that. Um, just shows you how, yeah, governments are not governance. What should I say? Governments are not forever. Things change, people change, societies change. People are very emotional, so it's hard to be extremely stable for a very long period of time. So it's always noteworthy when things are stable for a very long time, and that's why like the Roman Empire really hasn't been beaten, at least at a large scale. I think there's some like small republic states that are just like a city. That's kind of unfair comparison compared to a large empire with multiple ethnicities in it. Not that Rome didn't have its problems, but just as an example, things can fall apart. And people shouldn't get ho-hum on their own country, the U.S., whatever it is. There's always a chance things can change very dramatically, and you just want to have some options. Not to spread doomsday news or anything like that. But that's how I view it. Frank's in the house. No longer investing with Frank, but Frank Tabor. Actually, how do you say that, Frank? Is it Tabor or Tabor? I think it's Tabor. As I'm so used to calling you investing with Frank. Anyways, what edges do retail investors have over institutions, and what edge do you focus on the most? You love asking this question, Frank, or different iterations of it, and it's a good question because I think it's worth re-emphasizing and reminding yourself. At least that's how at least I like reminding myself of it, and that's that I think number one is your universe of opportunities is actually massive. And it is different. Like a Berkshire Hathaway is going to be able to do some pretty unique deals, like when they bought like Dominion Energy's like whole sector, their like whole arm of their company. Like you can't do that. You can't do these special deals, but you can look at small companies. You can look at private companies, even or friends and family business, if you will. You can start your own business. But as for investing on the public markets, there's a lot of different opportunities there that something like a Berkshire Hathaway with a ton of money or a large fund isn't going to look at because it's not going to move the needle. For you, a $10 million company, if it happens to be publicly trading, that can really move the needle. And you putting in $10,000 isn't going to dramatically move the stock price. Whereas if Berkshire came in, it'd be like, well, we have to buy the whole company and then some to have it have any impact on our shareholders. And at that point, they're not really a passive investor; they're just buying the whole company. So that's a big difference and a big advantage that people can take. That a big thing that retail investors can take advantage of. So that's probably the one I focus on the most. If you're just a retail investor, you don't have a fund, you don't have investors to appease, because I think that's a big reason that you often see this. The narrative against stock picking, which I bought into for a very long time, was that hedge funds with all of their experts can't even beat the market. The average hedge fund return is yada, 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 and it's less than the index. Therefore, invest in the index. That's the best thing ever. I think it's a very flawed thing to say that because, first off, hedge funds come in all different shapes and sizes. So it's kind of unfair to just basket them all into one thing. But let's just say your average kind of mid-sized fund of, I don't know, we'll say they got such a pretty large fund. Let's say they got $100 million that they're playing with, and that they have a lot of people in there. Every single one of those investors is a customer, and the fund's job is to keep those customers satisfied. Depending on how the fund is structured, but how a lot of like open-ended funds are structured, is they get a fee for assets under management. And if people leave the fund, guess who's missing out on fees? The fund. So the fund has a vested interest in keeping people invested in the fund, and they can increase their fees by one, getting more people to invest in the fund, or two, growing the money in the fund and getting returns that way. But that's pretty hard to do. So if someone is threatening to take their money out of the fund because they're not investing in X hype stock, well, what's the fund going to do? Now, all of a sudden, their incentive, show me the incentive and I'll show you the outcome, says Charlie Munger. Now their incentive is to invest in that hype stock. And they're suddenly going to be just like any other emotional retail investor, even if all their experts are saying, well, like, this isn't a great opportunity to actually make a bunch of money, but it's great for keeping fees high. So just that's kind of the incentive thing that's always ignored when we compare like hedge funds to like the broader index. It depends on the fund you're going into. I think the bigger the hedge fund is, it's probably more likely that that's the case. It'll probably follow what retail traders do. Plus you have hedges involved. So that's where the name hedge fund comes in. Many funds, but not all, put on hedges during certain types of markets. They'll buy put options, they'll buy credit default swaps. Bill Ackman does that. He, with his Pershing Square Capital Management, which I am a shareholder of. So that that means your return's probably going to be smaller, but your risk is also going to be lower too, theoretically, because in a down market, you're going to be protected. So it's a risk adjusted return. It might be pretty similar. So just keep that in mind too. But that's another one I focus on a lot. Don't think that because hedge funds can't make money in the market, you can't. I'm not saying go and pick stocks if you don't know what you're doing. You could make a pretty good argument that no one really knows what they're doing until they have a track record, and then they can prove that they knew what they were doing. Maybe if it's not survivorship bias. But that's what I would say to that. If you're really interested in stock picking, learn about it. See what great investors are doing. Maybe copy their methods, maybe don't, maybe improve on them. Just don't get cocky. And also don't just quickly assume that it's impossible to stock pick. You can't win. If you don't want to stock pick and you don't want to put the effort in towards it, then don't. Then do indexes or do whatever you want to do, or indices. I always say indexes. So that's what I would say on that point. So those are the two big ones. You don't have investors to appease. You have a bigger universe of opportunities, which are kind of different sides of the same coin, sort of. And in kind of more niche cases, you could take advantage of certain tax things that maybe a specific company couldn't do. Like with at least like on the real estate side, you can buy a piece of real estate and maybe that's more beneficial for your taxes, or maybe investing in a certain type of company that pays a certain type of dividend is better for your tax situation. That's like a more niche example. You can just be more flexible because, again, the first two reasons, you have more opportunities you can pick from and less people to appease. But thank you, Frank. Get a few. Oh man, the questions are pouring in. I want to get a few more in. We're approaching an hour here. This has been great. I'll get through as many of these as I can. Rico, what's your thoughts on LOT or IoT? Is that LOT or IoT technology and related cryptos like Jasmy Coin? Is this an ad, Rico? Sounds like a weird altcoin. I have no comments on that. Though if you're trying to pump, please don't. I say that without trying to insult, but I don't know what that is. I guess you said it's the first Japanese licensed Bitcoin, but I thought the licensed by what? Whatever. I don't know. I don't know about this. This sounds like a weird altcoin. Maybe I'm wrong. Enlighten me if I am. No problem, Herbo. David asks, number one pick for super investor to manage all your net worth. I think I've gotten a similar question like this in the past. Well, I guess you could say I've entrusted the plurality of my stock portfolio into Bill Ackman's hands, though I have my qualms with some of the things he does. I wouldn't mind Sam Zell. I have a lot of money with him too, technically through Equity Commonwealth. So probably one of those two. And then I would say someone like Warren Buffett, but he's getting up there in age. Or Charlie Munger, same thing, getting up there in age. I actually don't own Daily Journal, but I do own Berkshire. So probably one of those three, but given the time constraints on age, I'd be a little bit more worried on Berkshire compared to the other two if I had to just give all my money to one person. But Sam Zell's getting older too, and I don't know if he's going to be stepping back at some point. Anyways, probably one of those two, just if I had to pick one off the top of my head. Or maybe maybe one of my punch card buddies. So we're closer in age. We're also smaller, so we don't have people to appease. So maybe one of those guys. Frank, Tom, Karan, Brad. Wouldn't mind any of those. Anthony says, "How are the big law hours treating you so far? Do you find it affects your other interest at times?" I only ask because of the massive stigma big law has. So yeah, the hours are real. It's a lot. I was working today. I work 7 days a week. Part of that's by choice, but part of it isn't. I personally would rather work less hours over more days than more hours and less days, if that makes sense. So I'd rather have 6 hours a day rather than 8 hours, 6 hours a day for 7 days rather than 8 hours for 4 or 5 or something like that. but the hours have been intense, and especially during, oh man, September through November was pretty brutal. I had a lot of transactions, and it was very stressful. I did notice I got, you can't really see them on camera, but I got a couple gray hairs, I think from this fall that I'd never noticed before. Just a couple. So I'm a little worried there. I got pretty stressed out at some points. Never to the point of breaking down or anything, but it's taxing, both mentally and sometimes physically if you're not getting enough sleep. I do try to always get enough sleep. It's a little while there, especially where I probably wasn't getting as much sleep as I should have. Um, but that's relatively rare. It's been a pretty crazy fall and into this December. Does it affect my other interests at times? Well, yeah, of course. Like I would love to not do law work or legal work at certain hours, but that's what I signed up for. They're paying me a lot of money to do it, so I'm going to do it. It's a trade-off. I'm not going to it's not worth complaining about, because if I really didn't like doing it, then I just wouldn't. I would leave. But it makes sense to go with this opportunity. I'm learning a lot. That's one big advantage of starting in big law, if you have a good structure, of course, is that you're getting a ton of hours. And by the end of my first year, I'm going to have probably a few hundred more hours than the other person who maybe did not do big law. And they might have different benefits, and maybe they have a little bit more flexibility in the things they work on or whatever, but I'm not saying it's the greatest thing ever, but that is a nice advantage if you want to specialize in a particular area. But I mean, during the winter, there's only so much you can do anyways. And I find that I can be decently flexible. Well, it's weird because I never really clock out. I always have to be kind of on call. Like if anything pops up, I got to hop on it. Our team is pretty reasonable. I haven't felt like it's been super unfair or anyone's unreasonable. Everyone's working hard. Everyone's fair, even if people can be kind of blunt sometimes, but I'd rather take that than sugarcoating a problem. But that's part of learning. So anyways, I'm not, it's intense, and you have to be ready to jump on anything. So it's kind of hard to make big plans, but like I said, I'd rather spread out the work, and then I can do things like videos in the evening. On most days, some days I still have to work like a lot of hours in the day. So that's kind of what I'd say there. It's intense. It's pretty close to what I would have expected. It's just a lot of hours, and you do a lot of work, and you just have to focus on it. But there's a lot of good opportunities that are coming out of it too. And I'm meeting a lot of really, really smart people. Like it's, and they're really good people to learn from too, and connect with. And yeah, that's what I'll say there. So far, so good. 6 months in full time, about 9 months since I officially started. I started part time while I was waiting for my license, and then 6 months as a proper attorney. So far, so good. And I got promoted to associate level 2. There's like different levels of associate. So it means I'm doing things properly, I suppose. So moving up a level. And there's a number of levels you have to get to before you reach something like partner. And yeah, so far so good. And GC, if you leave Chicago, would you go to Vegas for tax benefits? Highly unlikely, no. I think my bias is to stay Central Time Zone. I mentioned Texas already. I think one thing with my Chase Sapphire Preferred points, I'll probably go to. My wife and I are planning on doing like an anniversary trip maybe next August, because I think I'll be pretty close to done with my yearly hours for that year. And depending on how workflow is, we can work around it. And she'll be done with her externship that she has to do to finish up. We could do. We want to do like an anniversary trip because we got married in August. And since we didn't really do much this year because, just things are blah. The last 2 years, it's been tough to do a lot. But I would want to do maybe like a Texas tour, like San Antonio, Houston, Dallas. I have been to Houston for a couple days, but I kind of want to just explore, see what's around. Maybe Austin as well. I'm not as interested there since it seems like it's turning into its own San Francisco. And I was at San Francisco recently and did not like it. That was in 2020, right before the lockdowns and everything. So I'd probably check out Texas first. Has plenty of tax benefits, though property taxes are quite high, but I'd rather take that. If my income is growing, I'll take the property taxes because they're relatively fixed compared to income going up. In Illinois, Illinois is a mess. So pretty much any state would be an improvement, except maybe like New York. Like it wouldn't be that hard to beat Illinois on general policy and taxes and everything like that. Yeah, California and New York are probably the only two that could compete at a pretty substantial level and beat it maybe. So Texas, I'd look at. That's really all I would think. It's central time zone, so it wouldn't be too hard to go back up to Chicago if you wanted to. Um, yeah, but no, Vegas is not on the radar. But thank you, GC. Christian, again, what do you eat for lunch in Big Law? Well, they feed us a lot, which is pretty nice. But generally, I'll bring leftovers. I don't, even though I'm making money, I generally do not pay for lunch, or like go out to eat for lunch. We buy our groceries, of course. But I'll typically have something like leftovers, and that works really well. So, I mean, what do we eat? Plenty of chicken. It's healthy stuff almost always. Chicken, veggies, rice, potatoes, like general food, and it can vary. Sandwiches, plenty too. Yeah, actually, lots of sandwiches. Yeah, so it varies. But then when we go out to eat with whether it be partners, associates, occasional clients, people visiting the office, we'll have whatever there, and I try. It's generally kind of the same thing: salads. I don't want to eat like a giant meal in the middle of the day. One day they did bring us Portillo's, which was ridiculous because Portillo's, for those of you who don't know, is a Chicago chain staple, really Chicago suburbs staple. And they serve like Italian beef, fries, hot dogs, very famous kind of Chicagoland staple. And it's they serve hot dogs, Italian beef, and French fries and chocolate cake for lunch for this like partner summit they had, and like everyone wanted to take a nap afterwards. It was kind of ridiculous. So that was the only like really kind of, I'll say gross lunch just because it was so fatty. But otherwise, it's typically just pretty standard stuff, sandwiches, and if you go out to a restaurant, you can get whatever. But yeah, they feed us a lot though, which is nice. It's a nice perk. Tabor, Frank Tabor. So I was right. Or as Australians would lazily say, Tabor. Couple more questions here. Ahmed again. Do you think Facebook is a relatively, or is a value play, we'll say, compared to other mega tech companies? It seems like it. It's one of the few big mega tech companies, as you say, that I own. The big tech. I used to have Amazon. I sold out of that. I held on to Facebook because like I wouldn't want to invest a bunch of money at these prices, but they throw off a ton of cash. They keep growing. How much more they could grow, that's what's hard to say because they're just an unprecedented level essentially, and it's kind of a frontier space, the internet space. So it's hard to say exactly. Now they're trying to get into the metaverse and all that. But I think compared to the others, but we were talking about relative valuation earlier in this show, and it's you got to be careful not to just say, oh, well, they're cheap compared to this expensive company, therefore they're cheap. Like, no, slow down. Are they cheap compared to your risk tolerance? Are they cheap compared to your assumptions? That's what matters when it comes to trying to come to an intrinsic value. Relatively, yeah, it seems like it, just because they, maybe it's because of political risks that people don't like or whatever. But yeah. Christian enlightening us on Jasmy Coin. Whoever had brought that up, I think it was like a Rico or something. There's a Rico. Jasmy Coin sounds like a rug pull waiting to happen. I don't know. So I'll just defer to Christian on that. GC a little more savage. When people actually believe something like Jasmy Coin is going to change the world, it makes me question the amount of common sense that remains in the human race. I'll say one brief comment on kind of this altcoin space. It's a wild west out there, so be very careful. There's tons of fraud. There's tons of opportunities to make money too, I suppose. But which ones are going to make money? I was not investing. I was hardly conscious during the tech bubble, but it sounds a lot like what the tech bubble is like. Anything that was an internet company, ping, shoots right up. Well, it seems kind of similar with any altcoin pops up. that has like a funny name that just shoots up to the moon and often comes right back down. So it's just it's a wild west. Got fraud galore. You have, I mean, these things don't produce anything. They're literally just tokens, digital tokens. And it's like you got to be really careful out there. I was already talking about gold. At least gold's a thing. Like maybe you think it's worthless, but at least you can hold it. Like you're buying a digital thing, a digital ledger essentially. And in some cases, it's like some of the advantages of these coins are that they're decentralized in some way and there's not centralized control. But in many cases, a lot of these new coins are just companies. They're centralized and they have all this control over it. So like, what advantage are you getting? Anyways, I not to get too deep into the weeds. I'm still a lay person on crypto, but some of the stuff is just so gross, and it's a shame because a lot of people are going to get hurt. Even if the technology, which is really cool in a lot of cases, just general blockchain technology and the things it can do, especially like smart contracts on the Ethereum side, I think it's super interesting. It's super cool, but I'm sure you could have said the same thing about the internet. Internet's super cool. Look how great it's going to be, but look at all the loser internet companies that came out of it. That's what I think is probably going to be the closest parallel, just because it's such a new frontier of technology. Who knows what company or coin or whatever is going to make its way out of it. So just be careful out there, is all I'll say. Arico coming back. Congrats on the promotion. Thank you. I appreciate it. Says your family's trying to move you there. Cousin's moving to Texas. Texas is booming. Yes, it is. And that's kind of the big reason. And plus, one thing I forgot to mention, warm weather. Chicago has terrible weather for like 2/3 of the year. The summers are nice. I'm much more of a hot weather guy. Always have been. So I like, oh man, when did our honeymoon in the Cayman Islands, it was like in August. So it's like the hottest possible. I was just like, oh, this is great. I'll just be able to go outside and just be kind of walloped with warmth. It's great. I run pretty cold, so that's probably why. So anyways, weather is better in Texas, but there's some risks there, like Houston in particular has like hurricane risk. Though I guess they had their like catastrophic snowstorm a while back. Tech, good to see you again. Happy Sunday, Monday. It is Sunday here in Chicago. What do you think about the metaverse? I don't have many thoughts on it. I haven't done a ton of research. I would just say that it's both interesting and frightening. At least the way I picture it. I picture kind of like a virtual world. You put on your headset, and you are not really in real life. You're in like a digital world, but there's some value there. You can see people all around the world in kind of a more comfortable setting, perhaps. That's pretty cool. Maybe you can see some certain sites that, or give you the illusion that you're there to see certain things. That can be cool too. It seems like a nice kind of extension of a lot of the things that the internet already does. Like, Google Maps, like instead of just going to Google Earth, you can literally go in there and check it out. That would be pretty cool. Or meet with friends and play a game or have dinner. You might be alone and you're on the other side of the country, but you can like pretend like you're having dinner with someone or something. Like, I don't know. Seems like there can be some cool things there the way I'm picturing it. But on the flip side, I'm a little nervous about people just becoming really antisocial or doing like just obscene things a lot because they're in like a fake world, and it wouldn't be as civilized perhaps as the real world. I wonder. I don't know. And also who's going to govern it, and then what kind of information is going to get that, whether it be the government, a company. So everything's a trade-off. It's interesting. We'll see where it goes. It's very new. I'm picturing more of like an augmented reality sort of thing or complete virtual reality on that stuff. So yeah, that's what I'll say there. Thank you, Tech. GC again, as someone from the UK, the tax system in the US confuses me to a degree. Do you guys pay state and federal taxes, like taxes to the state, which so yes, every state has their own tax regime. In many cases, every city or county will have its own sort of thing too. So at the federal level, they actually can't tax on a lot of things. Like the Constitution limits what the federal government can tax on. For example, the income tax there had to be an amendment to the Constitution in the early 1900s to allow the federal government to impose an income tax. That wasn't allowed at the federal level. And everything that's not reserved for the federal government is reserved for the states. So states can tax all sorts of things that the federal government could not do. So that's why you have property taxes at the state level. You have like gas taxes, different excise taxes, sales taxes. Not that the federal government couldn't do at least some of these things, but that's generally how it's done. It's kind of a hierarchy. The federal government can do a number of things, and it's often the biggest bill, unless you have a lot of property, and then property taxes might be a big one. So yeah, so I pay taxes to the city of Chicago. When I buy something, you have sales taxes. I pay money to Cook County because, or sorry, I think there's I think there's a city sales tax and then there's a state sales tax. Yeah, so I'm paying sales taxes to two entities, if I'm not mistaken. I'd have to double check. It's a lot. It's just there's taxes everywhere. The city of Chicago has like a hotel tax. There's Cook County property taxes. There's state of Illinois income taxes. There's federal income taxes, and so just taxes everywhere. But it's all kind of this tiered system, I suppose. And last thing I'll say there used to be this deduction that they're trying to get back put in called the state and local tax deduction. Well, it still exists, but it's very limited now, where any taxes I pay at the county and state and city level would be deducted from my federal taxes. So you wouldn't be paying double taxes essentially up to a certain level. And right now it's capped at I think $10,000 a person, whereas before there was no cap. So any state that had high taxes, it would basically be a write-off on your federal taxes. But that was since removed with the Trump cuts, and that's been a contentious issue. And I think a big reason a lot of people have left high tax states like California, Illinois, New York to go for comparatively low tax states, Nevada, Texas, Florida, these comparatively lower tax states. Because like all of a sudden you are saving a ton of money because that deduction is no longer there. So, so the more money you make, more taxes. Well, yes, of course. And no, Elon's paying a lot of taxes for sure. He's selling a ton of his stock this year. So, because even he thinks, well, I won't say what he thinks, but he clearly thinks it's worth selling Tesla stock at this point, given the valuation it's gotten up to. Maybe he has different reasons. He likes to claim it's for taxes, but he's going to be paying a bunch of taxes on that, almost certainly. And he said as much. But yes, generally we don't pay on unrealized gains. That would be a mess of a system if we suddenly impose that. Given how financialized everything is. That's kind of what a property tax is, I suppose. It's sort of like a wealth tax, but but generally the top 1% of income earners pay the like top half of all taxes or something like that. Or better yet, I think the top 1% made something like 20% of all the income, yet they pay 50% of all of the income taxes or something like that. It's some ratio like that. But in general, there's always these fair share arguments. Really, the rich in general pay a larger share than pretty much everyone else because basically under about, we'll say $40,000 per year, which isn't a ton of money, especially compared to millions and millions of dollars. You're probably not paying any net taxes because you're going to get write-offs or credits at the end of the year, especially if you're a family and you have a kid or two. You're going to get a child tax credit that's actually cash in your pocket. So I always find it funny when the people who complain about unfair share of taxes, one, don't realize that the rich do pay, in general, there are exceptions, in general pay a ton of taxes. They pay the majority of taxes. Or I should say they pay a disproportionately high amount of taxes, whereas people who don't make a ton of money actually pay very little because the standard deduction is like $18,000 per person. So anything under that is not taxed for basically everyone. So, or I think it's 18,000. I'm not giving tax advice, please. But it's a goofy system and there's a lot of misconceptions about it. I think because it's so complicated, which is a problem in itself. It's way too complicated. So I'm saying so a lot at the end of these questions. I need to get better at ending them. So, but thanks, GC. All right. I think I'll wrap it up here. Christian's final question. When will the channel hit 10,000 subs? That's a great question. Hey, I just crossed 2,600 a day, unless it's gone down since I started this live stream. So we're 400 away from 3,000. And that is And then that's only 7,000 away from 10,000. And that's only 90,000 away from 100,000. So, we're making big, little incremental steps. And we'll see where we get there. I think 10,000 is totally obtainable by next year, especially get a nice video taken off or a few videos. Maybe Punch Card takes off, Punch Card investing, and you can ride the coattails of that. That would be great too. Like whatever happens. I'm going to be pumping out the content either way and documenting whatever I'm doing in investing and also relevant news stuff I find interesting. That's what I'll always be doing. And to GC, when we pump Duffley coin, Jack's sub count will go to the moon. Yes, as someone like CoffeeZilla would say, pump the stock, pump the channel, hit the subscribe button. Would very much appreciate it. If you guys like these Q&As, definitely let me know in the comments below. If you're watching this after the fact, and you want to make sure you get your questions answered or whatever you want me to talk about, then be sure to hit that bell notification icon so that you can actually comment on my community posts when I ask for questions so that I can have something to start off these episodes with before the chat gets nice and lively. So yeah, that's I'll wrap it up there. Thanks everyone for stopping by. Very much appreciate it. Always enjoy doing these when I can squeeze it in. And otherwise, it's time to go eat some dinner. So thank you, everyone.